Hello, good evening, everybody. I am here today to discuss a little bit about the momentum screener that I made today. There were a few suggestions by people on Twitter, and I'll be emphasizing on those also. So without further ado, let's just continue with it. I'm sharing my screen now. Okay. So like yesterday, I'll first go through the code, explain bits of it, and after that, we'll discuss some of the special things that were asked on Twitter. Okay. So if you have seen the previous videos, you will be familiar with the way I organize the data before I start. Now there is a much more intelligent way of doing it that I save the data files, but since most of the analysis that I do are fresh, you can say, so because of that, I tend to repeat the process of collation all over again. So all of you would be familiar with this by now. I use the list.files to list out all the files that are there in a directory. After that, I create a null list object, empty list object. After that, sequentially using a loop, I download the, sorry about that. So then sequentially using a loop, I dump the CSV files into the empty list object, and then I R-bind them to form a massive data frame. Okay, so here I have added one extra thing that might be of use to some of you people. That is that you don't need to unzip the files before you use it in R. You can actually unzip it within the code itself. So for that, what I'm doing is within the loop, I am unzipping it. The function for that is called unzip, and you just pass the object name to it and the object which is the data name to it, and it will source it from that path, and then it will unzip it, and it will store it into an object called X that I've named X. Okay. After that, I'll be reading the CSV file of X. So basically, right now it has just been loaded into X as an in an indeterminate format. Okay. After that, when you read it as a CSV file, then it will read the CSV file within it, and then it will return you the data frame. Okay. After that, I'm dumping it into the empty data object, empty list object, and after that, the loop is done basically. So with this, all of the data will be put into this data list object. After that, I'm using data.table rbind list. You will be familiar with this by now. Data.table is a special package in R for efficient manipulation of data frames. And rbind list is one of the efficient ways of R binding, basically row binding different data frames. Okay, and it only works on list objects. So obviously, since data is a list object, I'm passing it into this, and I'm getting a full data frame called cold data. Okay. After that, I am organizing the date within that data frame, the dates column within that data frame into a format that R uses. So for that, I have talked about this before. The function is as.date, and you have to specify the format in which it is there in your file for R to recognize it and convert it into the format that R uses. After that, I'm ordering the data by the date. So basically it's an ascending ordering. The oldest ones will be at the top and the newest ones will be at the bottom. After that, towards the end of the analysis, I realized that two of the symbols had their names changed during the course of this analysis, meaning that in the last 60 days period, the names had been changed. So because of that, the symbol, I had to convert the symbols, back convert the symbols of those to the new symbol basically. So that was Motherson Sumi and Supetro. After that, I am breaking the entire data frame object into its constituent symbols. So I'm basically right now everything is in one consolidated data frame. I am breaking it up into multiple data frames based on the symbol. So each symbol will have its own data frame now, and that entire thing is being stored as a list inside a list object called split. Okay, so split, the function split basically does that. You can break up a data frame using whatever column you want, and it will be split up based on the factors, the levels of factors within that data frame, within that data column, and it will, all of them will be stored as separate data frames inside a list object. After that, what I'm doing is I'm doing calculating the returns. Okay, so because the methodology, okay, before we go on to the code of this, until now we have just prepared the data. Now I'm going to talk a little bit about what methodology was used. Okay, so for that, let's just open up the NSE methodology for Momentum 30. So this is the NSE document. It's freely available online. I've linked it on the web page also, and you can see it from there. You can download it from there. That is that document contains the methodology for all the Nifty indices. So in that, you can just Control F to find the momentum and just go to that part. Okay. Within that, I'm not talking about the eligibility. I'm just going to talk about the methodology that they've used. Okay. So what they have done is, first, they have calculated something they called a momentum ratio. Okay. So momentum ratio was calculated for two time durations, one for the past 12 months, that is 1 year, and one for the past 6 months. Okay. After that, the momentum ratio was calculated using price return divided by sigma. Okay, so I know that whenever a math symbol comes along or a Greek letter comes along, we all get very frightened of them. But it's nothing to be frightened of. I'll just explain everything in one go. Okay, so the price return that is being used, okay, that is the 12-month price return. So basically it is the 12 months back price to today's price. The difference between the two divided by the 12 months back price gives you the return in percentage terms. That is basically the price return. Very simple. Okay. After that, the next important thing is the sigma. Okay. So sigma is basically the annualized standard deviation of log normal daily returns of the stock for 1 year. Okay. I know that this sounds very frightening to people who are noobs at stats, but I'll try to explain it in a simple format. Okay. So you have got, suppose, a data series. You have got a series of numbers, 1, 2, 3, 4, 5, 6, whatever. Okay. After that, you know that the middle point of that data series can be considered as the mean or the median. That much stats most people know. Mean is the middle point, the average, and median is also the middle point, but that is the true middle point. Okay. So if the histogram of the data is a little skewed to one side or the other side, then the mean will not match the median. In those cases, median is the true middle point. But in cases in which it is a normally distributed curve, that is, the histogram is normally distributed, in those the mean will be equal to median. Okay, so in them, mean can also be considered the true middle point. Okay, now the problem is that many times the daily returns of a stock may not be normally distributed. Okay. Okay. Before we go on to that, let's backtrack a little bit. So mean and median equivalency you have understood. Now, after that, suppose you take the mean, the middle point. Okay. And you calculate the difference of each data point from the mean. Okay. You calculate the difference of each data point from the mean. Okay. When you do that, that basically becomes your deviance. Okay. That is called deviance. Okay. Now, the problem with the deviance is that when it is on one side, it will be positive. When it is on the other side, it will be negative. Okay. So basically, suppose the middle point is 5. Okay. So on one side, you have got 4. On one side, you have got 6 data points. Okay. These are the two data points, 5 and 6. 4 and 6. Okay. So deviance on this side is -1. Deviance on this side is +1. Okay. So because of that, if you try to come up with a consolidated measure of deviation of your data from the middle point, okay, you just can't use these solo deviance numbers because the negatives and the positives will sort of cancel each other out. Okay, it's not feasible. So what people do is they square those differences. Okay, so when you square those differences, then basically squares can never be negative, right? So they'll always be positive. So you square those differences, you add them up together. Okay, then you divide it by the number of observations. That gives you the variance of the entire thing. Okay, that gives you the variance. Okay, and from this variance, the standard deviation is calculated. Okay, now, 1 minute. Okay. Okay, guys, sorry for interruption. My daughter was trying to call me and she chatted away for quite a bit before she stopped. Okay, so let's continue on. Where was I? Yeah, I was showing you so I was telling you what variance is, basically the how much each data point hovers about the mean. Okay, so if you pick a random data point from that entire series, on an average, how far it will be away from the mean. That's what variation means. Sorry, variance means. Okay, so after that, you basically square root the variance and that gives you the standard deviation. Okay, so like I said, variance is calculated from the, so it's the standard deviation is calculated from the variance. The variance is calculated from the squared deviations and the deviations are about the mean. Okay, now if this entire process revolves around the fact that the variance or the standard deviation is equal on both sides of the mean. Okay, that is the basic assumption behind this entire calculation. If that is not true, that creates a problem because then your SD will be variable. It won't be a proper estimation of how much it differs from how much a random reading would be differing from about the mean. Okay. Now to reduce this effect, okay, to reduce the problems with calculation of the standard deviation or for that matter, any statistical procedure on individual values when they are skewed. Okay, there are certain transformation procedures available to make it look like normal. Okay, one of those transformation, you can search for transformation for or transformation to normal distribution. Okay, on Google, one of those methods is to do a log transform. Okay, so doing a log transform sort of like if it is too skewed, it won't be as skewed now. The log normal values won't be as skewed now. Okay, so that is the main benefit of doing the transformation. Okay, now after that you calculate the mean of the log transformed values, you calculate the variance from it, you calculate the standard deviation from it. The standard deviation of the log normal values, the logarithm of the return values will be a little better than if you do it on the native ones. Okay, but the problem is that many times the price change can be on the negative side. Okay, so if the price change is on the negative side, you cannot do a logarithm. Okay, so if you want to still go ahead with that procedure, you'll have to basically take the minimum value of the daily returns, basically the day that it had fallen the most. Okay, then you have to add that value to the entire column of values, and then you have, so basically then that minimum value will become 0 and all of the above rest will be positive. Then you have to do a log on that, and then you have to calculate the standard deviation from it. That just doesn't sit well with me somehow. Like it doesn't seem very intuitive to change the values in that way just to achieve normality. Okay, so because of that, I removed that step. I did not do a logarithm of the daily returns to calculate the standard deviation, and I just left them as it is in percentage format. Okay, so that is one of the places where I deviated from the methodology. Okay, now after that, the next thing is that you have to annualize it. Okay, annualizing a standard deviation derived from the daily returns. Okay, that will be done by multiplying the SD that you have gotten by square root of 252 if you want to annualize it. If you want to make it semi-annualized, you have to multiply it by approximately 126, square root of 126. If you want to reduce the duration within over which you are trying to extrapolate it, it's basically a scaling factor you have to understand. Like the SD, basically, if it will move a little bit within a daily format, it is supposed to move more on a scaled up format, that is on the longer duration. So because of that, we do that scaling. Okay, so I used the scaling factor of square root of 60 because that was the maximum number of days that I was calculating the return for. That is 1 quarter. Our Jace on Twitter, he recommended that I do it for a longer duration because what he tried to say was, what he said was, and what I tried to understand was that the denominator, that is when you are doing the momentum ratio, you are calculating the returns divided by the denominator, that is the SD, that is the annualized SD. Okay. Now the denominator in itself is a method of scaling the returns. Okay. And if that scale varies as much as the numerator, then that entire thing becomes a little more unreliable. So what he suggested was that I expand the scaling factor basically to make it more stationary so that I can observe the changes of that with the underlying regime, whatever is happening at that point of time. So, okay, so basically think of it like this. The base is sort of the overall regime with which the entire market is facilitating. Okay. And means basically the stock is facilitating, but the entire market is also facilitating, that is incorporated into the stock. Okay. And the top is just the price action, the close to close price action. Okay. So if the regime is also facilitating and the numerator will anyway facilitate, the price changes are anyway more of a random movement. Okay. Then the entire thing becomes non-stationary. It becomes a little problematic to decipher. Okay. If the base is more stable, then the changes in the regime won't affect the entire thing much, but the changes in the price behavior can be noticed better. Basically, what I think the way he was trying to explain was that it improves the signal to noise ratio, basically, within that stock's movement. That is what I understood anyway. So if he cares to comment on this video, then we'll know whether I am correct or not. But as far as I understood it, I tried to explain it to you. Okay. So that is how the momentum ratio is calculated. Price return in percentage terms divided by the sigma p, which is the annualized standard deviation of log normal daily returns. In my format, it is the scaling factor is square root of 60. So it is quarteralized returns, you can say, and the SD has not been log normalized. It is just in, basically it is the SD of the daily price returns. Okay, so they do this momentum ratio for a 12-month format, then they do the momentum ratio for a 6-month format in which the denominator stays the same, but the numerator is the 6-month price return. Okay, so they calculate these two momentum ratios. After that, they calculate the Z score of the momentum ratio. Okay, so you have got one momentum ratio for that date for that stock. Okay, like that you have got momentum ratios for multiple stocks. Okay, so what you do is you calculate the Z score of each of those based on all of those momentum ratios of all the stocks. Okay, Z score is basically how far each momentum ratio is away from the mean of all of those momentum ratios, and that difference has been standardized, meaning that that has been divided by the standard deviation of the momentum ratios. Okay, that is what Z score is. If you do not understand it, go on to Google. There are many resources to help you understand it. Z score is basically calculated for a normal deviation. It's basically a scale-free measure of seeing how far away an observation is away from the middle point. It's a scale-free measure. That's the more important thing. Okay. So you calculate the momentum, you calculate the Z score of momentum ratio of that column. Okay. And same, you do that for the 12-month momentum ratio. You do that for the 6-month momentum ratio. After that, you do a weighted average of the Z scores, meaning that you give equal weightage to 6 months, you give equal weightage to 12 months. You do multiply both of them by 0.5 and add them up. Basically, you average them. That is what they're done. It's basically an average. Okay. And that gives you the momentum score. I did not go ahead with this normalization procedure because anyway, the negative values of momentum mean that they are on the lower end of the scale. What is the point of normalizing them to make it positive and then calculate the, like see the topmost values? Like you might as well see the topmost values now. So that is why I did not normalize it during my calculation. I just stopped it at this step. And after that, I just took the top 30 Z-score values. Okay. So in my version, I did it in two other ways also. One was this equated version. The other way that I did was that I gave higher weightage to the 3-month momentum ratio and a lower weightage to the 1-month momentum ratio. I call this the steady momentum ratio, meaning that there's more importance given to the longer term momentum than the shorter term momentum. Okay, so it is 0.75 and 0.25. So earlier it was 0.5, 0.5 in the equated. Now it is 0.75 for the quarterly, 0.25 for the monthly. Okay, so this I call the steady momentum ratio. The next one that I calculated was the quick momentum ratio, meaning that I gave higher weightage to the 1 month and a lower weightage to the quarterly one. That is 0.75 for the 1 month and 0.25 for the back month. That is your quarterly. Okay, and all of these three ratios I calculated, and then the top 30 of each of them I have displayed on the web page. Okay, now after having covered all these concepts, let's quickly go ahead to the next part of the code, how I did it basically. Now for this, what I needed to do was I needed to have the returns of each of those stocks at the bottommost row. Understand this. I needed to have the returns of all of these stocks, the 1 month, the 3-month return and the 1 month return at the bottom of the data frame for each of the stocks. So it was basically a reverse of the way I used to calculate the returns earlier using the red func. Okay, so I reversed it. The NA padding that was on this side, I put it upstairs, and the bottommost value was at the bottommost part of the data frame. Okay, and I also calculated day 1 returns, and those day 1 returns were used to calculate the standard deviation, because the standard deviation is from the daily returns. Okay, so that is all. So this red func backward is a modified version of the red func that I used earlier to calculate the returns. And in this one, it is basically the back padding of the NAs is now front padded, and the entire thing has been shifted down. Okay, so if you play around with it, you will come to know what exactly I've done in this. After that, I created another loop to do all the calculations within it and give me out whatever I need. Okay, I'll just go through this loop quickly. So first I created an empty list called mom data, that is momentum data. After that, I iterated it over the entire split, that is over each symbol separately. Okay, then first thing to do was that I have to exclude all of those stocks who have a history less than 60 days. Okay, so basically like LIC or some of the newer ones, basically they need to be excluded. So I excluded them by this. So this is an if statement. This is distinct from the if-else statement that I used yesterday. The if statement can be used standalone. Basically, that if this situation is done, then you do this, and then you may or may not follow it up with the else statement. Okay, depending on your requirements. Here I've used the if without an else statement. Okay, so basically what I did was, if n row of split I is less than equal to 60, that is its look back period is less than 60, then next meaning that it will abort that iteration of the loop and go on to the next iteration of the loop. Okay, so that next is for that. Okay, and after that, this if statement is finished. If the if statement is not true, then it will continue the loop as it is. Okay, after that, I'm naming the split I, the ith iteration of the split as X. Okay, and after that, I'm naming it just as X. After that, I'm calculating day 1 returns using red func backward that I've shown here. So red func backward X dollar close 1 day, that is 1 day returns. X dollar D20 ret, that is 20-day return, that is 1 month return, as red func backward X dollar close 20, and X dollar day 60 ret as red func backward X dollar 60, X dollar close comma 60. Okay, so these are giving me the return values for a 20-day look back, a 1-day look back period, a 20-day look back period, and a 60-day look back period. That is a quarter. Okay. After that, I'm calculating the quarterly standard deviation. Okay, the quarterly standard deviation, which is required as the denominator of the momentum ratio, that I'm calculating here. So here, what I'm doing is that I'm taking the last 60. Basically, since the look back period that I want for the SD, that I wanted for the SD before Jace corrected me was 60. So I have taken that look back period of 60 daily returns, and I have calculated an SD of that. Okay, so this length X day one rate minus 60 is basically the length of day one rate minus 60. Then colon is 2, the length of day one rate. That is the length, last point. Okay, so last point and the minus 60 point. So all of those will be used for calculating the SD. So for SD, the function is SD. Okay, this NARM equal to true is required in R for many of the base functions, meaning that you do not want the NAs, that is the missing values, to mess up the calculations. Okay, you have to specify that in many of the base functions. So in SD also that is like that. If there are any NAs, then without this NARM equal to true argument, it will result, the SD will result in an NA. If you remove the NAs, like you use NA.RM equal to true, then you will get the actual value of the SD. Okay. After that, I multiplied it by square root of 60. Like I explained, you have to annualize it or semi-annualize it or quarterlize it to increase the duration, because these are SD of daily returns. You want SD of the entire time period. Okay. So with this, I got the quarterly SD. After that, I took the last value of the D20 rate, that is the latest value. Then I took the last value of the D60 rate, latest value. After that, I calculated the momentum ratios here itself, within the loop itself. The ratios are basically the day 20 return divided by the quarterly SD. M60 ratio is day 60 return divided by the quarterly SD. After that, I made a separate object to hold the symbol of the stock that I was doing. After that, I created a separate object for storing the date on which this was being done. And then I outputted the entire thing as a data frame. That is data.frame date, comma symbol, comma D20 rate, D60 rate, quarterly SD, M20 ratio, and M60 ratio. And after that, this out object gets fed into the empty data list, empty list that I created in the beginning before the loop, and it gets fed into it, and then the next iteration of the loop starts. Okay. After that, I just R-bind the mom data into a data frame. Simple. Okay. So let's just do this entire thing off, and then I'll show you where had we done it till. Sorry. Okay, I think it stopped somehow. I don't know, something went wrong. I'll just run it all over again. That's better. Okay, so I'll just run the entire thing from the beginning till this part. We'll just wait for it to finish. Then after that, I'll show you. Okay, so mom data has been created. Let me just show you the head of mom data, what exactly it looks like. Data. So in this one, like I said, like I made the output, it is in exactly that format. First date column, then symbol column, then day 20 return column, like past 20 days return, then day 60, past 60 days return, then quarterly SD that we calculated, then the M20 ratio and the M60 ratio. Okay, so the momentum ratios, the raw momentum ratios have been calculated now. Okay, now let's just continue forward. After that, the important thing was that what we did was on the entire CM data, the cash market, capital market half copy, which is available from the NSE. Okay, but we do not want all of those stocks. Okay, because many of them are ultra small caps and all, we don't want those. Okay, we want to stick to the N500 universe. There's a Nifty 500 universe. Okay, which includes small caps also. Okay, so but we will stick to only those. So for that, what I did was I downloaded the market cap data of NSE. They publish it, I think, every 6 months or so. The market cap data of all of the stocks on the NSE, and whatever the top 500 companies by market capitalization, I selected those, and then I selected only those companies in the MOM data which had those symbols. Okay, so to do that, I had already downloaded the market cap data, so I have named it as mcap.csv. Okay, so I read that CSV file. After that, I ordered the entire data frame by the market caps. So decreasing on a decreasing format because I want the largest market caps at the top. Okay. After that, I took the 1:500 row. The first 500 rows I selected out of the market cap data. After that, I selected out the stocks from the MOM 500, which from the MOM data, which matched the N500, that is the top 500 by market caps. Okay, so for that, I'm using the percentage operator. I had shown this to you in the last video. If you want to learn about it, you can go to that video and see. Okay, so finally we have ended up with, so let me just show you what this MCAP looks like, the market cap data. So head of MCAP. So this is what the head and the MCAP looks like. You have got the serial number, a symbol, the company name, and then the market cap of it. And I think this is in lakhs. I'm not very sure, but this is the market cap basically. Okay. After that, I've ordered it by decreasing equal to true, and I've taken the top 500 and put them into an object called N500. After that, I'm going to after that, I'll be selecting out only those N500 stocks. Okay. Now let's just see what is the N row of MOM data. N row of MOM data is 2071 because there are 2071 stocks that were in our criteria that we fed into the loop in the beginning. Okay. Now let's just look at the N row of MOM 500. That is the first 500 companies by market cap. It is coming out to be 498. You can see that there are two missing, right? Why do you think there are two missing? Probably because some of those companies are, what do you say? Some of those companies are may not have completed 60 days on the National Stock Exchange. Okay, so that is why two companies got excluded. Okay. So, okay, so these things are done. Okay, so now we have made the MOM 500 data. Okay, now if you want to look at the head of MOM 500, let's do that also. Head of MOM 500. So there's that same thing as before, only only some of the stocks have been included, like 3M India, Aarti Industries, etc., etc. Okay. Now let's go back to the final calculations that need to be done. First, we need to calculate the Z-score. Okay, so for calculating the Z-score, what I did was you take each individual value of M20 ratio, subtract from it the mean of M20 ratio, divide it by the SD of M20 ratio. You remember what I told you before? Exactly that same thing. Only how to use the mean and this SD, you need to use the NA.RM equal to true. Okay, just remember that always. Okay, in R, especially in base R, keep using NA.RM equal to true. It's useful in most circumstances. Next, I'll do the same thing for M60Z. Again, the same thing. I'm taking each value of M60 ratio, subtracting the mean of M60 ratio from it, and dividing it by SD of the M60 ratio. Okay. After that, I'm combining them into that equated format or quick MR or steady MR that I described at the beginning of this video. So for that, multiply both of them by 0.5 and add them. Multiply one of them with 0.75, other by 0.25 and add them. Multiply one by 0.25, other by 0.75 and add them. Okay, so this is giving me the overall momentum ratio in 3 different formats. Okay. After that, I'm just ordering. So again, I'm ordering the MOM 500 based on each of these momentum ratios. So decreasing order, meaning that highest momentum ratio has to be at the top. And of those, I'm selecting out the first 30, the top 1 to 30. Okay, so I've done that for all the three. After that, I'm writing them into CSVs. The CSVs are available for download at your discretion. After that, I have just made one separate statement here because I don't want to be caught unawares later on if any of the stock names get changed. So basically what this says is that if a unique MOM 500 date is more than one, basically if I'm doing it for that last day, okay, the dates of all of the stocks should be the same. So the unique date should be one. If the unique date's length is more than one, that means some of the stocks stopped trading at some previous time point. That is why it is coming like that. So that last date is also coming as the max date. Okay, so then it is so if this criteria gets fulfilled, then it will print some stock name has changed, please check, for me to know that something has gone wrong. Okay, otherwise it will just run smoothly, no message will be printed. Okay, after that, the last part is just to make a picture out of the table that you are seeing on the web page right now. Okay, so I hope that this was useful for all of you. I went a little deep. I hope that does not bore most people. And after this, I plan to modify this syntax based on Jason's recommendation as soon as he replies. And next step would be to calculate do a backtest on it and compare the returns of this with the returns that I'll get with the original momentum index of the NSE. Okay. So until then, thank you for watching. Bye-bye.